This is by far one of our most requested videos. Today, we're going to cover some really important topics around investing and retirement planning and how the election could impact them. Anytime there's uncertainty about the future, the markets tend to become more volatile as they brace for impact. So today we'll talk about what we know for certain, which is how the markets have behaved in various cycles, whether Democratic or Republican. And then I'll discuss some of the biggest mistakes we see federal employees make in the TSP or other investments in election years. I'll also talk about what you can do if you are retired or you're thinking about retirement, since volatility is most dangerous to you. And the markets are not the only thing to worry about. Change in tax policy will have a huge effect on retirement plans and will cause many families to have to go back to the drawing board. We've got a lot planned for today, and I really think this is going to be very helpful to you. So make sure to catch the whole video so that you too can be prepared for the election. There's a lot of variables that affect the markets. Sometimes one thing can impact the markets in one year, and that same variable may have no impact at all the next. This is why investing can be so challenging. I can't stand to see the phrase unprecedented one more time, and I know you probably feel the same way. So first, let's talk about a few things to keep in mind as we move from here. When we're planning our clients' retirements, we look to the markets as only one of the tools that we have to help us meet our objectives. Its variabilities is just a part of using this tool. But let's look at how the markets, here defined as the S&P, has behaved during elections in the past. This first chart is from Fidelity, and it looks at stock performance through different elections. The first thing we want to notice here is that it does look like volatility can be expected. We have some pretty wide swaths here of different times where the markets did indeed become quite volatile during or after an election. Depending on which year you're looking at, the markets may have been either much higher or much lower than its preceding or post year. Now, this is due to a number of reasons, including policy change, which could come with a change in administration. Remember that tax planning is a major part of retirement, and it has a huge impact on your investment strategy. However, one thing that I'd like you to notice is that the average tends to remain positive even through various different cycles. So despite there being a lot of volatility, the average of the volatility does end up in the positive for most of the time. So this is important to factor as you're thinking through your investment plan. Now here's another chart from them. Here we're looking at various parts of the market. So all of these different sectors is what we would call them of the overall markets. And this graph is looking to identify, did any of these sectors outperform one year or underperform another year through various different presidential cycles. And as you can clearly see, the data is all over the place. We have a pretty even split between some doing well and some doing poorly in both types of administrations. So this tells us that picking the right portfolio strategy for you is even more important when the markets do become more volatile. I need you to remember that the volatility that comes in the markets is a bigger risk to you in the short term than it is in the long run. So especially for anyone planning retirement, or if they're already retired, then that short-term volatility presents a bigger risk that you need to address. Now, it's noteworthy to notice that these three sectors on the bottom appear to have underperformed the rest of the markets surrounding elections, but again, everything is relative. But now let's zoom out a bit and look at this from a macro perspective. We know that the president's office is just one part of our government structure. The profitability of companies and the health of our economy is also highly influenced by policy change. So what's happened when we've had a split Congress, or when it was Democratic or Republican led, and when we had opposing presidential seats? Let's look at this one together. This chart is from Capital Group, and what we show here is the average annual S&P performance throughout the 1930s through 2022. We've got a couple of years in there, specifically 2001, due to a senator changing party, so they just took the data out so it wouldn't be skewed. History tells us that having a divided Congress tends to work out better for the markets in the long run. And the reason for this is because if we have a split Congress, then really we're looking at a gridlock situation in terms of new laws. And anytime we have gridlock means that there's a lower probability of any laws being passed, and less or no change means that investors are familiar with the environment that they're currently in and are more likely to be bullish or optimistic about the markets in the long run. Remember, it's the uncertainty in the markets that creates that suspicion and creates worry, which leads to volatility. The changes really start to happen when we have Congress that is dominated by one party or another. And again, that's because we would have uncertainty about how tax laws could change or a variety of different components that will influence the economy, which ultimately influences the markets. Now, before we jump to any conclusions, we need to zoom out even further and look at how markets performed over time. Here's another chart from Capital Group. Here we have the hypothetical growth of what an investment in the S&P index would have done over time. In this period, we're looking at both Democratic and Republican administrations. Does anyone see a trend here? The markets have this unrelentless force driving them up over time. In other words, while elections can absolutely cause short-term chaos and short-term volatility in the markets, in the long run, stocks have tended to trend higher regardless of which administration was in power. Now, the challenge for you and I is that we don't live in 4 or 8 years or even decades at a time. We live day to day. And if we zoom in on any one of these cycles, we can see that there's obviously a lot of volatility in any of these years. And that short-term market volatility presents a real risk to a retirement plan, especially if it coincides with the beginning of a retirement. Anytime someone is in the decumulation phase of their life rather than the accumulation, that volatility presents a much bigger risk. You see, if you're still young and investing for growth, then one of the best things you can consider doing is being aggressive in your portfolio. If you don't need the capital soon and you put it in the right places, then you have the opportunity of participating in that growth in the long run. But when you're retired, you don't have time to wait 2, 3, or even 4 or more years for the markets to recover just because you're not earning an income anymore. So what can you do to give yourself the best chance of success? There are some tried and true methods of retirement planning and strategies that really allow you to get the most out of your wealth. And I'm gonna cover several of those later in the video. First, I wanna talk through some common mistakes that we see from federal employees during years of elections. But before we do that, if you're enjoying this so far or you learned something new, let us know by hitting the thumbs up. Now let's talk about some problems that people cause for themselves. The biggest one I've seen over the years is that people tend to abandon their plan when things get tough. Risk is a very interesting concept. In fact, risk is an arbitrary concept until you experience it. The idea of rehearsing getting punched in the face is one thing, and then actually getting punched is totally different. You can rehearse all you want, but it's probably going to be different than you anticipated. And I've seen that retirement planning can be very similar. Even though in the long run, it's clear that things are likely to be fine in the markets, it's your actions during those difficult times that determines the rest of your outcomes. This is why everyone can have such varying results, even though everyone is investing in the same markets. It's not until you're really in the thick of it that you start to feel it. Meaning, once you're no longer working and you're drawing from your portfolio, and that happens to be the year where everything in the economy starts falling apart, you're going to start questioning whether you are still doing the right thing, whether new action is required, and if you should be reacting to what's happening. Now, a good plan is going to have built-in different ways that you can pivot during these times. What happens if the markets do this? What happens if life does that? You see, most people think that a retirement plan looks something like this, a straight line from point A to point B. But the reality is that the variables of life start to deviate your plan from the line that you thought you were living. And most retirement plans actually look closer to that. And the decisions that you make at these inflection points are what determines your outcomes and whether you're still headed in the direction of the ideal future. You want to know how you need to respond before the problems arise. Otherwise, I promise you'll be scattering in the moment. And there's no shame in this. As humans, we are hardwired to want to protect what is ours. The only way you can keep yourself from making a bad decision in the moment is having a good plan well ahead of time. Another major mistake that we see is people often thinking that they know better. If you're feeling nervous about what could happen in the markets because of the election or everything else that's going on, well, you're in good company. Investors tend to be much more conservative during election years. Take a look at this graph from American funds. This chart shows us the amount of money that's going into a money market fund, known as cash, compared to equity funds or stocks during a presidential election year and then in the year after an election. So during the presidential year, we have $195 billion flowing into cash. So investors are putting 5 times more money towards cash than they are in stocks within an election year. Now note that this data does just go back to the early 90s, but I think it's really interesting for us to consider. Now in the following year, look at how much flows into stocks rather than inside the cash or the money market positions. And the problem with trying to time the markets like this is that it rarely pays out in the long run. In fact, we just looked at how the markets perform over time, which means that it could actually be counterintuitive to be leaving the markets during the election. If you miss only 10 of the best return days in any given year, you've missed out on more than half the growth available in the whole year. A few years of this here and there could be the difference between a successful retirement plan or one that requires changes. Peter Lynch of Fidelity once said, "Far more money has been lost by investors in preparing for corrections than has been lost in the corrections themselves." Okay, so we talked about how the volatility that comes with uncertainty could be dangerous to a retiree. So now let's talk about what are some things that you can be doing in your retirement plan to help insulate against these issues. First, I need you to think carefully about your short-term bucket. Market fluctuations is the biggest risk during the short term. This means that you want to have a plan to consider for your short-term needs. Now, how do we define short-term? Well, for some families, it could be 6 to 12 months. For other families, it could be as many as 5 years. Everyone's going to be a little bit different, but I can tell you that generally speaking, holding 5 years of cash is probably not going to be the best thing for you, at least for most people. There are many instruments that you can consider for your short-term bucket. It doesn't and shouldn't just be cash. You may consider things like money markets or T-bills, short-term bonds, or treasuries. You can also consider other income-producing investments to help provide the cash flow you need. I want you to think about your entire portfolio in bucket terms. You might have 5 or 6 different time horizons that you divide your overall wealth into. Now, this is just an example that I have on the screen, so it's not designed for you to take this and use for yourself. But the idea is that the longer you have before you need to access your money, the less volatility is really a risk to you and going to be impactful. So generally speaking, the more aggressive your portfolio is capable of being. But these short-term buckets, you don't have a lot of time for that. These buckets can't be subject to a lot of the ups and downs, because what happens if you need to use your money and it coincides with a year that the markets have fallen in value? Well, now you could be selling investments at a loss, making those losses permanent, and that can really hurt your plan in the long run. So I want you to start thinking about your money in this compartmentalized way. This is just one way of approaching it, but it resonates with a lot of federal retirees, and I think it could be helpful to you too. Now, the other thing that this will do is it will start to create greater diversification in your overall portfolio, which is always a good and necessary thing for retirement. One of the greatest examples of this is looking back to the early 2000s during the tech bubble. If you had a portfolio that was invested in small cap stocks, then you were doing much better than everyone else who was really heavily focused on the S&P or those big technology names, because that's where all the money was. So again, if you have a lot of time to recover from that, hey, take as much risk as you feel like taking. But if you're coming up on retirement, that diversification component may just be what saves you in the long run. We can't promise many things in life, but I can promise you that the markets at some point of your retirement are going to do the opposite of what you really want them to do. That's when having the right plan matters most. These moments in time can be really hard lessons that retired feds will learn, only to forget about them once the next bull market starts again. So please, folks, if you know that your retirement plan needs work, now is the time. Get ahead of these issues. You don't want to wait to learn how to use a parachute after you've already jumped out of the plane. There's something incredible that comes with having the peace of mind and understanding how all of it will come together for your benefit. Building in what-if scenarios and understanding what bad markets will do and how you should act, that can be priceless for a lot of families. So I hope you found this valuable, and if you're not subscribed yet, then consider doing so. And let me know your thoughts in the comments. What do you think is going to happen in the markets here after our election? Until next time, stay wise and stay wealthy.